Mortgage rates just crossed above 6% again, right when buyers were starting to get excited about spring, right when it finally felt like things were turning around. One of the main reasons, a war overseas, and the chain reaction it set off in oil, inflation, and the bond market. In this video, I'm going to break down all of that in plain English. No finance degree needed. I'm going to show you exactly how a conflict thousands of miles away is showing up in your monthly mortgage payment and what you can actually do about it right now. We're going to cover what just happened to rates, why it happened, the two directions this could go in, and what smart buyers and sellers should be doing today. If you want real talk on housing and mortgages, not hype, not scare tactics, hit subscribe, tap like, and let's get into it. Let me set the scene for you really quick. Heading into late February, 30-year fixed mortgage rates had actually dipped below 6%. That was a big deal. We hadn't seen that in a long time. And buyers who had been frozen out, people who looked at rates nearly 7% and said, there is no way, and you know what, I'm going to buy today, they were starting to come back to the table. Agents were talking about one of the more active spring markets we had seen in a while. Then the US and Israel launched strikes on Iran. Financial markets went into what traders call risk-off mode. And I'll explain what that means in a second. But the short version is this. Rates jumped back above 6% in just a few days. Now going from 5.9 to 6.1 might sound like almost nothing. But here's the thing. There's a huge psychological difference between a rate that starts with a 5 versus one that starts with a 6. Buyers feel that. It changes what they're willing to do. Now, that's the first and most direct impact. More volatility and a payment jump that knocked a lot of people's plans sideways. Okay, here's the part that trips most people up. Why does something happening on the other side of the world show up in your mortgage rate here in the US? Let me connect the dots for you. Think about the Strait of Hormuz. It's basically a narrow waterway right off the coast of Iran. And here's the wild part. About 20% of the entire world's oil supply passes through that strait every single day. It's like a highway that almost all the world's oil has to drive down. When there's a war, risk anywhere near that strait, traders immediately start worrying. What if that route gets blocked? What if supply gets cut off? And when they worry, they bid up oil prices fast. Now here's where it hits your everyday life. Think about everything you buy: groceries, clothes, furniture. All of it had to be shipped somewhere. And shipping runs on fuel. When oil goes up, a truck driver's fuel cost goes up as well. A factory's energy bill goes up. The extra cost doesn't just disappear. It gets passed on to you and me at the store. That's inflation. And it's not just gas prices, it's everything. Think of it this way. If the price of flour goes up at a bakery, the price of your bread goes up too. Oil is basically the flour for the entire economy. Now, stay with me here, because this is the key connection. When investors think inflation is going to stick around, they get nervous about lending money long term. Why? Because if they lock in a loan at a fixed return and inflation keeps rising, they're actually losing ground. So they demand higher interest to make it worth their while. That demand shows up in something called the 10-year Treasury bond yield. And your 30-year mortgage rate basically follows that yield like a shadow. When the yield goes up, mortgage rates go up. So the chain looks like this: war risk, oil price spikes, inflation fears rise, bond yields go up, mortgage rates go up. That's why what happens in the Strait of Hormuz can literally change the rate your lender quotes you this afternoon. Okay, so where do we go from here? Economists are watching two main scenarios, and I want to walk you through both because they lead to very different outcomes for housing. In this version, things escalate, markets panic for a few weeks, oil spikes, rates jump. But then the situation calms down, tensions cool, oil prices drift back down, and rates come back with them. If that's how it plays out, spring buying season gets delayed, not destroyed. Buyers wait a few weeks on the sidelines, things settle, and activity picks back up. Home prices probably hold firm in that world because inventory is still relatively low across most of the country. Long, messy conflict. In this version, the war drags on. There are more attacks near the strait. Oil stays high for months. Inflation doesn't cool off, and the Federal Reserve, the group that influences short term interest rates, feels like it can't cut rates the way people were hoping. In that case, mortgage rates stay high even as the economy slows down. That's a tough combination for housing. Payments stay expensive, demand stays soft, and buyers and sellers both feel stuck. Short conflict, bumpy but manageable. Long conflict, more pain, more waiting. Let's talk about what this actually feels like if you're out there trying to buy right now. First, payment shock. I want to show you the real numbers. Going from 5.9% to 6.2% on a $350,000 loan adds about $67 a month to your payment. That doesn't sound crazy until you realize you're already pushing your budget. And that extra 60 something bucks is the difference between this works and this is too tight. Secondly, uncertainty. A lot of buyers were already on the fence before that. When you add a war, some people say, you know what? I'm going to wait and see what happens. And honestly, I understand that feeling. But here's the flip side that almost nobody talks about. Fewer nervous buyers in the market means less competition. For the serious ones, if you're financially solid, not just pre-qualified, but fully underwritten, meaning your income and your credit have actually been verified, you might find you're negotiating against fewer people right now than you were 6 months ago. So here's my advice. Stop trying to time rates around a war. That's a game you won't win. Instead, ask yourself 3 questions. Number 1, do you genuinely love the home? Number 2, can you comfortably afford the payment at today's rate, not at a rate you're hoping for? And number 3, do you plan on staying long enough to ride out some volatility? If the answer to all 3 is yes, you can always refinance later if rates come down. You can't go back and buy that house once someone else takes it. If you're selling or you're a homeowner thinking about the next move, the rate spike hits you a little differently. Every time rates tick up, some buyers get priced out or get cold feet. Fewer buyers means potentially fewer showings, more days on market, and less leverage at the negotiating table, especially in higher price markets where affordability was already stretched thin. But here's something important. We're not in a market with too many homes. Most of the country still has very low inventory, not enough homes for sale. Think of it like a store running low on inventory during a sale. Even if fewer customers show up, the shelves are still mostly empty. Some prices don't crash. That's why even with softer demand, we're not seeing big price drops nationwide. Now, what about the millions of homeowners sitting on 3 and 4% mortgages? They're not moving. Why would you give up a 3.5% rate to borrow more money at 6? You wouldn't. and most of them aren't. That lock-in keeps supply low and keeps prices from collapsing. If you need to sell for a real life reason, such as job changes, growing family, divorce, relocation, price it right for today's market. The buyers who are out there are motivated. They're not window shopping. If you don't have to sell, hang on to the low rate. It's one of the most valuable things that you own right now. Here's the bottom line. The war with Iran is not blowing up the U.S. housing market, but it is adding a new layer of uncertainty on top of a market that was already fragile. Through oil and inflation, it pushed rates back over 6%. And it reminded all of us that global events can change your home buying plans overnight. If you're buying, you must know your numbers. Get fully underwritten, not just pre-qualified. And when you see a rate that makes the payment work, move. Don't wait for the perfect moment that may never, ever come. If you're selling, fewer buyers doesn't mean disaster. It means you need to be priced right and show well. Correctly priced homes are still selling. The market rewards preparation. If you want me to break down what any of this looks like for your specific situation, whether you're in a military market, a high-cost coastal city, or you're an investor trying to figure out your next move, drop your question in the comments. I may turn it into a dedicated video just for you. If this helped you make sense of what's going on out here, tap the like, hit the subscribe, and share this with someone who is stressing out about buying or selling in 2026. My time is up, but I thank you for yours. As I always say, let's be good to one another. Let grace abound. Check out these next 2 videos. They'll help you on your journey to becoming a homeowner. And for the rest of you, indeed, y'all stay blessed.